Good afternoon. I'm Dr. Amita Tiwari. I'm from SIRT Bhopal and the SAGE Group. And I want to continue my topic of the cost of capital. Today, we will discuss about the cost of capital of theories. And first of all, we introduce the theories of the cost of capital. And theories of the cost of capital, there is conflicts view. The matter of dispute is related to the act, whether the method of the level of significant financial affects the cost of or not. There are some important approaches as traditional approach and the Moniglery-Miller approach is the MM approach. Traditional approach argue that the cost of capital depends upon the method and level and financing of its capital structure over cost of capital changes according to the changes in the capital structure or changes in the debt or equities. Debt is a cheaper or tax savings and increase used in the debt result in the reducing the reduction of the weightage average and how increase used to debt result in increased risk and increased cost of equities and which may result in the increasing cost of capital after point does the firms has to maintain proper balance between debt and equities. And Molly-Villani-Miller approach is the MM approach, is the opposite to traditional approach. Capital structure will not affect the cost of capital or cost of capital is dependent upon the capital structure. Capital structure argue that the methods labor financing is not affected the cost of capital. According to them, is the increased use of debt through the reducing the cost of capital, increased risk reduce the shareholders to expect more or their investment, and the increase the cost of equities, and that this results offset the reduced cost of debt and the increased cost of equities. There's also mentioned the role of abbreviate process, the maintaining the cost of capital. Calculations the cost of capital. The firms obtain funds from the different sources because the consortial obligations, the risk difference, the cost of each source may be different. And thus the cost of each source to be determined is it is no as a component a cost of capital and specific cost of capital since the company make use the capital raised from the different source combined cost all sources of capital to be determined. Combined cost of the capital is known as cost of capital. Average cost of the capital is weightage average cost, overall cost of capital and cost of capital used to decision the making purpose and determine the optimum capital structure and investment decisions. And determinations of the cost of capital firms involves two steps. Determine the specific cost of capital and determinations of the weightage of the cost of capital. Specific cost of capital is a debt to precious equities and retained earning, and cost of debt is a return expected by the lenders. It is a cost of incurred by the firms in acquiring the using debt, and debt is an important source of when borrowing funds and different source of borrowing. Firms has to be obey and obligations of payment and interest and repayment. Further, debentures and bonds can see issues repaid in the different ways and calculations of cost of capital in this way. And the KD is equal to I and R is equal to INT upon 100 into 100. Is INT is interest and F is a face value of the debt and floating cost. And the cost of debt issues and premium is INT upon SP is a sales proceeding, and the tax implications is INT SP upon 1 minus T. And the cost of redemptions of the redeemable debt is a formula is R upon SP ki power 1 minus T is a floating charges and period of issues. And issues at discount is KD is equal to R upon SP is 1 upon 2 T. As you can say that the INT is a flotation sources upon the period of issues and amount plus is amount of discount and the period of issues. Issues at premium, KD is equal to R on SP, 1 minus T. And the cost of preferentials, low obligations to pay and prefers dividend, not charges in profit, and not payment will not lead to bankruptcy. And that is not right. Issues to shares, not the intention of the payment or dividend, not payment of the advisory affect market values of share, and companies pay dividend of the share preference shares. The calculations of the preference shares, KP is equal to dividend over sales procedures. And the cost of redeems is a D plus RB minus SP upon N and RB plus SP upon 2. And the abbreviations of these numericals value is in below. Cost of equity shares is a no legal obligations, payable only earn sufficient amount. Many argue equities capital and cost free, and investors in equities and anticipation of the dividend. This company has to pay dividend, the rate of dividend expected, the investment outside the shareholders, it a discount rate of equities and present value expectations. The different methods are there, and dividend is a price D upon NP, and NP as a D is a dividend per shares, and NP is the net procedure per shares and market per shares. Demerits: not consider the growth in dividend, does not consider the future earning, retained earning, and does not consider the capital. The growth in dividend methods is KE upon D, 1 upon NP plus G. G is a growth rate, and NP is a net procedure per shares, and D1 is expected dividend per shares at the end of the year. The earning per share is earning per share upon NP, and NP is earning per share is an NP or net procedure. Cost of retained earning, no cost, but not correct, as opportunity cost distributed to shareholders. They can invest and earn the lost earning, the shareholders, and continue to the opportunity cost. In KR is equal to D1 upon NP plus G and D1 upon NP. And however, the shareholders are not the intent to get the entire earning of dividend, and they no tax on the dividend and brokerage other expenses when they purchase. In the case of formula exchange is KR upon D1 upon NP into plus G. And the weightage average cost combines all the cost basically. So far we had discussed is specific. The firms raised funds from the different sources. Each source will have a different rate of earning, and we have calculated the composite cost of capital and also know the required rate of returns and the average cost of each specific earning. Is the average of cost on different sources, the capital calculations by giving the weightage, and the importance of each sources as the proportionate, and then hold the total capitalization of the firms. It is a formula of the weightage average cost is the KO is a EXW upon EW, and the aggregations is giving all the points and determine the cost of each sources, assign the weightage of each sources, multiply the cost, and sum of all products obtain the third steps to the get an overall cost of capital. Marginal cost of capital, it is calculated, and the capital assets is a very important. It's a capital asset pricing model, risk-free, and the risk investment is risky. We have a considers risk involved in the calculations is cost of CAPM model. So considers is a risk involved in the business while calculating the cost of capital. The required rate of returns calculated under the methods help by valuing. It can also be used to determine the cost of equity. So the assumptions that investors expect more or risky investment than the risk free. And it's a formulas of the risk premium and the risk free. And this is the last topic of the is a beta. Beta basically it is a market fluctuations of the market fluctuations of the any shares. It is the formula of the CAPM model is K is equal to RF plus RM minus RF is a beta, and risk-free rate is if the government security considers as risk-free, and the market risk premium is generally taken as the difference between the long-term arithmetic average of the market return and risk-free rate. The beta of the firm's share is the systematic risk for any ordinary shares in the relations of the market. That's the explanations about the methods of the cost of value. We can share next topic in the next session. Thank you so much.